In the 1600s, the Dutch East India Company operated a vast fleet of ships to trade goods like gold, porcelain, spices, and silks across the globe. Managing such a large operation required significant funding. To finance their costly voyages, the company turned to private individuals who could invest money in exchange for a share of the ship's profits. This innovative approach allowed the company to undertake even larger expeditions, boosting profits for both the company and its investors. By selling these shares in coffee houses and ports across Europe, the Dutch East India Company inadvertently created the world's first stock market. Over time, this concept evolved, and companies began raising funds from investors to support various ventures. Today, the stock market is a complex system with entire industries, educational programs, and media channels dedicated to understanding it. But how do companies and investors use the market in the modern era? Consider a new coffee company looking to enter the market. First, the company pitches its idea to major investors. If they see potential, they invest early and support the company's initial public offering, IPO. The IPO marks the company's debut on the public market, where anyone, individuals or institutions, can buy shares if they believe the business will succeed. By purchasing shares, investors become partial owners of the company. Their investments fuel the company's growth, and as it becomes more successful, more investors may take notice and buy shares. As demand for the shares rises, so does their price, increasing the value of existing shares and attracting even more interest. For the company, this surge in investment funds new projects and boosts its overall market value by demonstrating widespread confidence in its potential. However, if a company begins to appear less profitable, the opposite can occur. Investors may sell their shares to avoid losses, causing demand and share prices to drop. This decline reduces the company's market value, potentially leading to significant losses for investors unless the company regains its footing. This dynamic of supply and demand is influenced by numerous factors, including material costs, technological advancements, labor expenses, leadership changes, public perception, and even broader economic policies. Market fluctuations can create daily volatility, making companies appear more or less successful. In the stock market, the perception of losing value can lead to actual losses as investors withdraw their support. Human confidence plays a crucial role, driving everything from economic booms to financial crises. This unpredictability is why many experts advocate for long-term investing rather than chasing short-term gains. Despite the challenges, professionals continuously develop tools to navigate this complex system. The stock market isn't exclusive to the wealthy or powerful. With the rise of the internet, everyday individuals can now invest in stocks just like large institutions. As more people educate themselves about the market, they can trade shares, support businesses they believe in, and work toward their financial goals. The first step is simply getting started.